Forex trading is the buying and selling of currencies, where one currency is exchanged for another. Forex trading takes place on the foreign exchange market, also known as the FX market. The FX market is the largest and most liquid financial market in the world. Forex trading is done in pairs, with one currency being quoted against another. The first currency in the pair is called the base currency, and the second currency is called the quote currency. Exchange rates are the prices at which one currency can be exchanged for another. The exchange rate is affected by various economic and political factors, such as interest rates, inflation, and geopolitical events. Forex traders aim to make a profit by buying low and selling high. Traders can open a long position, where they buy a currency in the hope that it will increase in value, or a short position, where they sell a currency in the hope that it will decrease in value. Leverage allows traders to control large positions with a small amount of capital. The use of leverage can multiply potential profits but also increases the risk of losses. Forex trading happens 24 hours a day, 5 days a week, allowing traders to take advantage of global market opportunities. There are various trading strategies and technical analysis tools that traders can use to analyze the market and make informed trading decisions. Some common technical analysis tools include candlestick charts, moving averages, and Bollinger Bands. Effective risk management is crucial in Forex trading, as losses can quickly outweigh profits. Forex trading can be done through various trading platforms, such as MetaTrader, that provide real-time market information and automated trading capabilities. Successful Forex trading requires discipline, patience, and ongoing education.